Good morning, good afternoon, good night. Welcome back to another Schema Scalper video. Well, welcome to the Schema Scalper video if you're new. In the last video in this series, we looked at understanding FX quote conventions and we looked at base and so this is what we looked at, the base. Oh my gosh, my brain is not here yet. We looked at the trading codes. And we looked at based and quoted in the in the FX symbol, with the base being the first currency and the quoted being the second, quoted or the term being the second currency. Okay, so we're on to the next lesson. This is lesson 3, the importance of FX futures pricing and basis. Okay, it's a 7-minute thing, but I realized that I'm taking a bit longer than what the estimated time is, usually about 3 times as long. So let's get into it. The importance of FX futures pricing and basis.
The difference between the futures price and the spot price of a currency pair is referred to as the basis. Basis can be either positive or negative. It will depend on the relationship between the short-term interest rates of the base and the term's currency being considered. The base currency is the first currency in a currency pair quotation, and the quote of terms currency is the second half of the quotation. The price of an FX futures product is based on the currency pair's spot rate and a short-term interest differential. The pricing formula is similar to how FX forwards are priced in the OTC market. What does the pricing formula look like? In FX futures price formula, R represents the short-term interest rate of a currency, and D is the number of days from trade settlement until expiration. If the short-term interest rate of the quote currency is lower than the short-term interest rate of the base currency, futures should trade at a discount to the spot rate. The basis, futures minus spot, would be quoted as a negative number. This negative number is the result of what is known as positive carry. It is referred to as positive because an investment in the base currency's short-term interest rate generates more income than the income generated by the quote currency's short-term interest rate. Let's look at an example. Consider Mexican peso US dollar futures, quoted in American terms as MXN USD. The Mexican peso is the base currency. Assume it has a short-term interest rate of 4.25% with a term settlement to expiration of 82 days. Assume the US dollar has an equivalent dated short-term interest rate of 0.70%. Notice that the US dollar rate is lower than the Mexican peso rate. This implies positive carry, so the futures price should be lower than the spot. If the spot price for Mexican peso versus US dollar is 0.05158, what would be the implied futures price?
Okay, I can't do this in my head. I don't have a calculator with me, so I'm just gonna continue watching the video.
Let's plug in our numbers to find the results. First, 82 days divided by 360 equals 0.2278. Now, multiply that number by each currency's short-term interest rate. Add 1 to each result and then divide the base number into the terms number. Before going on to the next step, notice the resulting multiplier is less than 1. This implies positive carry because it will reduce the futures price relative to the spot rate. If the terms rate was higher than the base rate, the resulting multiplier would have been greater than 1. That would have meant negative carry, and futures would price at a premium to spot. Now multiply the spot rate times the multiplier. The result is 0.05116. The basis equals futures minus spot, or 0.05115 minus 0.05158, which is a negative 0.00043, or otherwise considered a negative 43 points. Let's take this further. We will change the time value to expiration from 82 days to 30 days. How does this affect the multiplier? Using the same calculations, the new multiplier is 0.99705, which is higher than our multiplier at 82 days. This means the futures price, while still lower, will be closer to spot. This is because of the erosion of the time value of money, or time decay. As a futures contract approaches expiration, the time value of money runs out and futures price converges towards spot. The 30-day implied futures price comes to 0.05143 versus a spot of 0.05158. When we subtract the futures price from the spot, we get a negative 15 points. The basis has narrowed from negative 43 to negative 15. At expiration, futures and spot will converge to the same level. Let's recap. For FX futures, basis is the difference between the futures price and spot price of a currency pairing. There is a cost of carry consideration for FX futures products. This is a determining factor in whether the futures price trades at a discount or a premium to spot. Regardless if futures are trading at a premium or discount to spot, the prices will converge at expiration. This demonstrates the pricing integrity of the futures contract and provides market participants the confidence to use them in trading and risk management strategies.
Yo, that was so interesting. I didn't understand it fully. I don't understand it fully yet. But what I do understand is that closer to expiration, the futures price will converge onto the spot price. And by converge, I mean go closer to. So if it's further away, futures price, like it's higher than the spot price, it will then trend down to the spot price, or if it's lower, then it will trend up to the spot price. That's how I understood it. Let's read on further. Understanding FX basis. The difference between the futures price and the spot price of a currency pair is referred to as basis. Basis can be either positive or negative. It will depend on the current relationship between the short-term interest rate of the base and terms currency being considered. The base currency is the first currency in the currency pair quotation, and the terms currency is the second half of the quotation, which we just went through in the previous lesson. FX futures pricing. The price of a FX futures product is based on the currency pair's spot rate and a short-term interest differential. The pricing formula is similar to how FX futures are priced in the OTC market, over-the-counter market, in the following equation. R is the short-term interest rate of a currency and D is the number of days from the settlement until expiration. If the short-term interest rate of the terms currency rate is lower than the short-term interest rate of the base currency, futures should trade at a discount to the spot price of the currency pair. The basis, that is, futures minus spot, would be quoted as a negative number. This negative number is the result of what is known as positive carry. It is referred to as positive because an investment in the base currency short-term interest rate generates more income than the income generated by the terms currency short-term interest rate. Okay, first interest rate means more than the second interest rate. Okay. For example, consider Mexican pesos, US dollar, quoted in American terms, MXN-USD. The Mexican peso resides in the base currency position. Assume that it has a short-term interest rate of roughly 4.25% for a term settlement to expiration of 82 days. So then inside here goes in the interest rate of US dollar, interest rate of Mexican pesos. Inside here goes in the 82, which is the days to expiration. Okay, and then the USD resides in the term position and has an equivalent dated short-term interest rate of 0.70 0%. Notice that the US rate is lower than the Mexican rate. This implies positive carry, so the futures price will be lower than the spot. Using the input provided along with the spot equivalent rate of 0.05158, resulting in implied futures price of 0.05116 versus a quoted mid-market price of 0.115. Futures are equivalent to a 43 points under spot due to positive carry. Going one step further, we will change the time value to expiration from 82 days to 30 days. How will this affect the multiplier? The multiplier will begin becoming shorter, the basis number will become smaller. Using the same calculation, the new multiplier is 0.99705, which is greater than our multiplier at 82 days. That means the futures price will while still lower, will be closer to spot. This is because of the erosion of time value of money or time decay. As a futures contract approaches expiration, the time value of money runs out and futures price converges towards spot. That right there is so interesting. Okay. The 90-day implied futures price comes to 0.05143 versus spot of 0.05185. When we subtract the futures price from the spot, we get a negative 15 points. So these are the multipliers. Sorry, not multipliers, the calculations. So it's 82 days, 30 days, 6MZ6. 6M means Mexican pesos. Z means, what does Z mean? Does it mean December? I'm not sure. I think it means December, and 6 means the year 2016. So 6MZ6, just make a new tab. 6MZ6 meaning trading. It should be Mexican pesos, Z December 2016. It's not showing. Okay, let's go back. We'll come back to it. I think that's what it means. I'm not too sure about the Z because I don't know the months properly out of my head. I usually just have a cheat sheet next to me. The basis has narrowed from negative 43 to negative 15. At expiration, futures and spot will converge to the same level. So interesting. In summary, for FX futures, basis is the difference between the futures price and the spot price of a currency pairing. There is a cost of carry considering for FX futures products. This is a determining factor in whether the futures price trades at a discount or a premium in regard to the spot price. If the If the terms rate is greater than the base rate, futures should trade at a premium to the spot price of the currency. However, when the term rate is less than the base rate, futures should trade at a discount. Should trade. Ooh. Think we might be getting something now. The basis or difference in futures price versus spot can be either positive or negative. What is important to remember is that regardless of whether the basis is positive or negative, the futures price will converge to spot as it approaches expiration. In other words, as time runs out on the futures contract, the interest rate differential has less effect on the futures price, and that futures price converges towards the spot price. In the terms rate, if the terms rate is greater than the base rate, futures should trade at a to the spot price of the currency. So it's discount, premium, spot price, or equivalent value. So one is greater than the other, so equivalent value is out. Spot price is out, so it's either premium or discount. If the term rate is greater than the base rate, so the term rate being the second currency is greater than the base rate, futures should trade at a, the answer would be discount. Yeah. What? Premium. Okay, let's go over that again because that doesn't make sense to me yet. Consider Mexican pesos, US dollar, quoted in American terms as MXN USD. The Mexican pesos resides in a base currency position. Assume that the short-term interest rate of 4.25 and 82 days to expiration, and then the US short-term interest rate of 0.70. That means that is the base, and that is the term. So the base is higher than the term, and we've got a positive basis. This means to be in premium. No, wait. No, it's a negative basis points, which means that it will be in premium. If it's positive basis points, it will be trading at a discount. Okay, I think I've got it now. Super interesting. If you guys are enjoying this lesson series, click the playlist, which is named Introduction to FX. It's a full playlist, and I've done the other 2 videos already, so please do go and check them out. Otherwise, be safe. Cheers.